All right, welcome to episode 9, I think, of the overnight sessions. I'm still coughing a lot, so forgive me if you guys get like random spikes in the microphone. But you already know today I switched it up a little bit. I got the quarter zip on. So all I'm saying is when you own zero point zero 0.05 shares of Ralph Lauren, like I do, you'll start dressing like me. That's all I'm saying. But of course, I had to put something Nike on, so I have the hat. It's my last shot at pumping the stock because that stock hasn't gone anywhere in like 3 years. But anyways, we have a lot to get to in this video. The first topic that we're going to get to is my watch list on Google Sheets. So I'm going to take you guys through a bunch of the metrics that I'm always bringing up. I've talked about it in previous videos a lot. And I have like plenty of educational videos, whatever, in the past, but I don't know. I guess I'll just organize it all in one video and lay it out, nice and organized to the best of my ability. This spreadsheet isn't perfect, but it's something. And then we have a YouTuber that a lot of you guys recommended me or requested that I react to. So we're going to get to that. We got Keith D. I'm just going to watch whatever his most recent video is. And then a second video, Bitcoin versus XRP. One of you guys recommended to me. So let's get right into it. So this is my spreadsheet. Over here on the left are the metrics that I like to look at whenever I'm looking at a stock. So, a lot of YouTubers that you guys watch will have like their format. You'll notice, fundamental people, they'll have their PE ratios, they'll have their PEG ratios, whatever, their price to sales, I don't know, price to whatever. And technical guys, they'll have their own indicators, they'll have like their risk to reward, risk management. You'll notice a lot of that stuff. But with me, one thing you'll notice is I just like to take a broad approach, right? I like to take a bird's eye view whenever I'm investing in a company. I like to buy stocks that I think have a future, that are important for the future, and that are very meaningful to society and where we're going, if that makes any sense. Like Robinhood, for example, is one of my big winners. It is my biggest winner. And it's changed finance, right? And I saw a big opportunity with it. These are a lot of the metrics that I looked at when I was investing in Robinhood, fundamental wise. Technical, I get to that. Sometimes you guys will see me on the charts or whatever, but this video is going to be mostly like fundamentals of what I look at. But if you guys didn't yet already know, if you want updated stock prices in your Google Sheets, all you got to do is type Google Finance and then the ticker or the cell right here. I put C2, and then in quotations just put price, and then it'll like update, I think, every 20 minutes or so. So that's kind of useful. I wish it did that with everything else because I had to like manually type all this out. And just another disclaimer, these are estimates. These are not like exact. Obviously, numbers are always changing in business and finance, so I can't give you like the exact numbers, but I can give you like the best to my ability. All right, so these are a bunch of stocks that are on my watch list. FCF is free cash flow per share. This is free cash flow yield. This is dividend per share. This is the 5-year revenue trend, and it's like a rough estimate. It's just a guideline to see like what the path looks like for them. TBV is tangible book value per share. ROIC is return on invested capital, just rough estimates, of course. 5-year share trend, does it seem like shares are going down or going up and they're diluting? Like I said, these are estimates because some stocks you'll notice they dilute a lot, but then recently they announced like stock buybacks. Just the first one that comes to my head is REPX. It's a small cap that I have a small investment in, and they dilute shares a lot, but recently they announced a stock buyback, so it's like, they still dilute, so I put up, you know what I mean? But Anyways, we have Adobe first off. Free cash flow per share for Adobe is roughly $21, which brings it to about an 8% free cash flow yield. I like to see somewhere around like 7. So you guys will notice 7 and up will be green. Anything below 7 is typically red. So that's pretty good for Adobe. No dividend for Adobe. 5-year revenue trend will have 13% roughly, right? That's a rough estimate. So don't yell at me if they do like 20% or 10% this year. I'm just doing like rough estimates. Tangible book value is negative, so I assume their balance sheet is not looking good, which is the one bad thing I think about Adobe. Like if their balance sheet is rough and business is like in a slowdown period right now, right? Then that might be bad for Adobe, which is probably why shares are down pretty bad right now. But return on invested capital is really good, 25%, and they are buying back stock, so not the worst on my watch list. Circle is another one that I've had my eye on. Free cash flow per share is really nice for a fintech, right? A 5% free cash flow yield for a fintech is not bad at all. No dividend, of course, because they're still in that growth stage. 5-year revenue trend is 60%, rough estimate, but still, that is eye-popping. And a positive tangible book value for a fintech, right, and a newer one. That is very impressive, most likely because they diluted the crap out of shareholders when their stock price was surging. And by the way, that was the smart thing to do. Look out for the balance sheet rather than praying and hoping that their 1000% stock return holds up or whatever. But return on invested capital is kind of low, like 6% rough estimate. And of course, they're diluting shareholders. When your stock goes to like 300, I think Circle was at the top, they're going to dilute, and it's a good thing in the long run. Short-term investors, they're going to suffer a little bit, but in the long run, their balance sheet is going to look really nice. So, it's Circle. I think they report earnings next week, if I'm not mistaken, somewhere this month, and it's definitely a stock that I have my eye on. Fig is another one I have my eye on. I think Adobe would have been much better off if they actually bought Fig, but I think the government blocked it, unfortunately. I think it would have been a great deal for both of them. But anyways, it's about $26 a share right now. Had a good reaction on earnings. I wish I would have bought before earnings and traded it, but I didn't want to suffer or potentially suffer anymore during this earnings season. We got free cash flow per share, about $1. So, it would have been a much higher free cash flow yield before this earnings pump. So it would have been roughly 5%, but it's slightly below 4% now, which isn't too terrible for an early stage growth company. It's like a software company, and I don't want to say too much because I'm not sure how much I'm allowed to say, but I have used Fig before to test out products for certain companies, right? And Fig, I was very impressed because Fig is basically a software company that lets you test software. And I believe they have some deal with an AI company right now where you can code with that AI and then import that code directly into Fig. And it'll basically create like a test software for you. So I think that's very impressive. But basically Figma is a software company that lets you test out your software before rolling it out. And I think that's very useful. So, I don't think they'll get disrupted by AI because, like I said, they're partnering with AI companies. I thought they were very impressive. 35% rough estimate for revenue growth, pretty good. Positive tangible book value, so their balance sheet must be positive. Diluting shareholders, of course, just like any early stage growth company, but definitely another one I have my eye on. Ralph Lauren, $12 roughly free cash flow per share, so that's only about 3% free cash flow yield, but also keep in mind they've had a tremendous run with their stock price. So, it sucks to miss that ride, but they would have been more than 5% free cash flow yield. But they do pay a dividend, which is very nice. And if you look at their free cash flow per share and their dividend per share, their free cash flow definitely they can afford that dividend, right? Revenue growth trend kind of slow, about 3% rough estimate, but it's a clothing company. Tangible book value positive, $31 per share is their tangible book value. So balance sheet, very nice. Return on invested capital, very impressive, 12%, and they're buying back stock. So another one to have my eye on. Like I said, I'm rocking the Ralph Lauren right now. So definitely have my eye on it. CRM, CRM and Now I would say are like the top two software stocks that I see a lot of retail investors buy into. I don't own any, but CRM is looking pretty good. I mean, 185 right now, $13 of free cash flow per share, which brings it to about 7% for a software company. That's pretty good, and they pay a dividend that they can afford, right? 5-year revenue growth trend about 10%, which is not bad. Tangible book value per share 5, so at least they're positive. Return on invested capital about 7% roughly, and then 5-year share trend down. And by the way, if I get any of these numbers wrong, guys, please comment down below, because like I said, these are rough estimates. But we got Now, which is another popular software stock that a lot of retail is buying right now. About $4 free cash flow per share, which brings it slightly below 4%. Not too terrible, no dividend. Tangible book or 5-year revenue trend, 23%, very nice. A positive tangible book value, so positive balance sheet. 8% return on capital, which is not bad, but they are diluting shareholders. So one thing that I want to see from them, at least, is to stop diluting. I think that would be a big step for Now. We got Novo, which is another popular retail stock that I see online. It's about $1.50 in free cash flow, but unfortunately they pay out all of their free cash flow in dividends, right? And they're buying back stock, so I assume they're using debt to buy back stock, which is one like red flag, I guess you could say. But 20% revenue trend, which is very nice, and they're kind of winning that battle against HIMSS right now, so it is one positive for Novo. Positive balance sheet, at least 20% return on invested capital. So one thing I want to see from Novo at least is to bring the free cash flow up so they can actually afford their dividend, or just cut the dividend, honestly. Shore up that balance sheet. I don't think and the stock has been beaten down, correct me if I'm wrong, but just cut the dividend and start buying back stock. Get that stock back up to a healthy level. I don't know. What do I know? I'm just a dude on the internet, right? But Zoom, another, I guess you could say, software stock, whatever, with $6 free cash flow, which brings it to about 6.6% free cash flow yield. Very nice. No dividend, a 5% revenue trend. And this is rough estimate. I could be wrong. But $30 per share tangible book value. So very nice balance sheet. 10% return on invested capital, roughly. So about double-digit return, and they're buying back stock. So Zoom is not bad. Axon, another popular one. By the way, if any of you guys have never been tased, I'll tell you what it feels like. It feels like if you've ever been stung by a bee, but in your entire body. Just saying. And if you guys have never been stung by a bee or been tased, then y'all need to touch grass, honestly. Just kidding, but not kidding. Anyways, free cash flow per share, $2. So very low compared to that stock price, right? Axon has been one of the biggest performing stocks the past few years, or past decade, if I'm not mistaken. Axon and Melly, I know Melly's another big one, but very low free cash flow yield, right? No dividend, of course, because they got to get that free cash flow up. But very nice revenue trend. They basically have a monopoly on law enforcement, government contracting. It's almost a monopoly, almost. Please don't sue me, Axon. But tangible book value per share, positive, so very healthy balance sheet. Return on invested capital, roughly 3%, and they're diluting. But just one thing I want to see from Axon is just to boost up the free cash flow per share, but I think I have it on my watch list because technically they've been beaten down recently. So I'm just looking for a trade. But like I said, it's just a watch list, right? Next one, GME, another popular retail stock that has been looking good technically. But free cash flow per share is at 5% now, so not bad. Tangible book value is positive, so healthy balance sheet, right? So, financially, GameStop is healthy, but they just have no like revenue trend, which is why it's blank, because I'm pretty sure it's negative still. They just can't find any growth, right? They need to make an acquisition, and I think the CEO announced that they're going to look for an acquisition. So it's good to see that the CEO is addressing their biggest weakness, which is the biggest weakness that I'm seeing, their growth. So free cash flow wise, balance sheet wise, they're looking good. It's just this revenue, right, and return on capital. But they've also been diluting, of course, because of that whole frenzy, which is good because it shored up the balance sheet. But we have Melly. Melly is definitely another one that I want. I would say out of this list, Melly, Circle, are like my top ones that I'm looking at, and then maybe CRM and Zoom, and yeah, Ralph Lauren, Fig, of course. But definitely top two, I would say Circle and Melly. But free cash flow per share is ridiculous, 169, which is about an 8.5% free cash flow yield. Crazy, 50% revenue growth, rough estimate. But balance sheet healthy, return on capital is healthy, so the money that they invest is working, and they're buying back stock. Like, what more could you ask for, right? At this point, the only thing you can ask for is a dividend. They could pay $100 per share annually in dividends and still be healthy because of their free cash flow, which is ridiculous, right? Funny, not really funny story about Melly. I've known about the stock for a very long time, and I know it's one of the top performers, but I've just never really been attracted by it because I never really knew what it was firsthand. I never experienced it firsthand, if that makes any sense. If you guys haven't yet already noticed, I like buying stocks that I actually like see in real life. But recently I was on vacation to Mexico, and in Mexico I noticed basically everybody still uses cash, right? But there was one dude with a stand, like a little gift stand next to a cathedral. I don't know if that's a sin or not, but I noticed he has Mercado Libre, the payment system, POS, right? And it was just so much more convenient. It literally shows you the foreign exchange rate on the screen, and the rate was better than cash, obviously, right? Because when you're exchanging in cash, you got some people that kind of want to milk you, but also at the same time, the foreign exchange market is always fluctuating, so most people just don't want to deal with that headache of calculating it and all of that, keeping up with it day to day, so they just round up, and that round up causes you to pay extra, right? But Mercado Libre, it literally gives you the exchange rate on screen. And I noticed when I went to purchase his little gift shop, merchandise items, it was much cheaper than the entire time that I spent in Mexico paying in cash. So, I really like it. I think it's, Melly is basically like the Shopify / Cash App of, South America. And it's like that Square payment system, but kind of like Shopify's e-commerce thing that they got going on. So, I was very impressed by it. But so Melly is up there. Netflix, free cash flow per share, 2.2. So very low free cash flow yield. But, the stock has been beaten down. So we could possibly see this yield go up. 12% revenue trend, very good. Positive balance sheet, but they are trying to make an acquisition right now of Warner Bros. So this could possibly change. But return on capital is 19%, and they're buying back stock. So, mostly good with Netflix. MLI is like a lesser known industrial company. And I like to mix it up with different types of companies instead of just only software and fintech. You know what I mean? So I like to mix it up a little bit. We got an industrial stock here that I have my eye on. 5% free cash flow yield, pretty good. They pay a dividend, very small and affordable. Revenue has been slow, but I assume it's because they're cyclical, maybe. I don't know too much about the company yet, but it's possibly cyclical. So sometimes they go through boom periods, sometimes they don't, and it's like a needs-based business. So, revenue is not going to be like Melly's 50% over here. But healthy balance sheet, right? $29 of tangible book value per share that you're getting, 19% return on invested capital. So, whenever they do put money to work, it actually does work, even if revenue isn't up there, right? And they're buying back stocks. So, TPL, speaking of TPL, I just got to stop and show you guys this. Look at this. What in the world? I mean, if you would have bought like right here on this candle, that's a 46% return in what, less than 2 weeks, 16 days. That is ridiculous, man. That's a beautiful looking candle here too on the 200 daily. Man, and I own like a little bit of it. I want to say I own like $100 worth of TPL just because I don't put too much money into like reinvesting. But man, that is a company. That is a stock. But very low free cash flow yield. But dividend is affordable. We got the revenue trend 10%. Very nice, healthy balance sheet. 30% return on capital, and they buy back stock. So for any of you guys that don't know, TPL, from what I know, they just own land. They own land, and then they'll like rent out or collect royalties off of like mining companies that want to come and use their land to take out resources or oil or like real estate. I think they do a little bit, but basically they just own land, and then they let other companies do the hard work for them, and they just sit back and collect a dividend. That's what they do. So their margins are very high, but at the same time that results in like a company that everybody wants, a stock that everybody wants, and a very low free cash flow yield. That's just how it is sometimes. But $18 of free cash flow per share in Meta, so it's a low free cash flow yield, but they do pay a very affordable dividend, 16% revenue trend. So healthy balance sheet, healthy return on capital, and they buy back stock. So yeah, I mean, that's Meta for you. It's basically, if you guys haven't noticed, most of big tech is like this similar situation that they got going on, right? Like you got low free cash flow yield, but you got a small dividend, healthy revenue growth, a healthy balance sheet, healthy return on capital, and they're buying back stock. So most of big tech is like a similar situation. But AMD, I know a lot of you guys own AMD, so I decided to put that on the list for you guys. Low free cash flow yield, healthy revenue growth, tangible book value, so healthy balance sheet. They just got to bring their return on capital up, right? They got to bring it up to NVIDIA level, and they're diluting a little bit. So, but other than that, AMD might join, the big boy club over here. And Google, Amazon, similar, basically the same story as their big tech peers here. So only one red zone, which is their free cash flow yield. Good revenue, good return on capital, healthy balance sheet, and they buy back stock, right? So most of big tech is the similar situation. Tesla, lots of red, low free cash flow yield, low revenue growth. These are rough estimates, guys. Relax, rough estimates, but healthy balance sheet. Return on capital is kind of low, but keep in mind this is like a very capital intensive business. So, and they dilute. So, But Visa, similar picture here to the rest of big tech. We got a low free cash flow yield, but a dividend that's affordable, revenue growth, return on capital, buying back stock. Cake, I know a lot of you guys own Cake, decent free cash flow yield right now, dividend that they can afford, decent revenue growth for like a restaurant company, healthy balance sheet, and healthy return on capital, and they're buying back stock. So moving on, we got Robinhood here. We got a low free cash flow yield, of course, because they've had a tremendous ride from the lows of $10. But we got crazy revenue growth, healthy balance sheet, return on capital is kind of low, 5%, and they've been diluting. But recently, they have been buying back a lot of stock. And one of the great things about Robinhood is they're very picky about when they buy back stock. So they usually reserve money for when the stock is tanking a lot, like right now, and then they deploy a lot of capital. Correct me if I'm wrong, but I've seen on X that they bought back a lot of stock recently at around $80-something, at an average price of 80-something. So, great timing by Robinhood, in my opinion. But we got Nike, low free cash flow yield, unfortunately. Most of their free cash flow is paid out through dividends. So that is one bad thing that I don't like about Nike. I hope their free cash flow juices up a lot more so they can reinvest into the business. Revenue trend has slowed down a lot. Healthy balance sheet though, healthy return on capital, and they're buying back stock. So I would say the only thing I want to see from Nike is juicing up that free cash flow, right? Juicing up the free cash flow and get growth back on the right track. American Express, look at this, all green. It has a decent free cash flow yield even after this crazy ride. Healthy dividend that they can afford, healthy, very healthy revenue growth, very healthy balance sheet, very healthy return on capital that they invest, and they're buying back stocks. So like, it's what more could you ask for in a company, Shopify, so low free cash flow yield, right? Similar situation to other tech stocks. 5-year revenue trend, very healthy, 30%, healthy balance sheet, healthy return on capital, but they're diluting shareholders. So the only thing I want to see from Shopify is just keep juicing up that free cash flow and get to a point where you're not diluting. And like I said, with this category here, this is a 5-year big picture, right? So over the past 5 years, obviously they've been diluting shareholders, but I think most tech companies right now have slowed down that dilution, especially after getting to a healthy place. So yeah, I mean, that's all I want to see from Shopify. Just keep growing and just get that dilution down. But Lemonade, so unfortunately no free cash flow yet, but they had great earnings recently this past quarter. So what I want to see from it, Lemonade, is just get free cash flow positive, right? Get free cash flow positive, get a positive return on capital, and then once you get a positive free cash flow going, stop diluting shareholders, right? So get to a healthy position with free cash flow, and then use that cash flow to supplement what you've been diluting shareholders, right? But anyways, we got Disney, so low free cash flow yield, surprisingly. So decent revenue growth, it's just barely getting there, 7%, that's the average. But positive balance sheet, 5% return on capital, and they buy back stocks. So with Disney, basically I just want to see them get back to growth, right? That revenue has been just average for a very premium company, and make movies and projects that are very profitable and very successful. The recent Predator movie was very successful. I want to see more of that, and then you keep pumping out good projects. That return on capital will go up, the revenue will go up, and that free cash flow will go up eventually. We got Cava, very low free cash flow yield, but that revenue is eye-popping for a restaurant company. Positive balance sheet, okay, it's average return on invested capital. If they're borrowing at 5% and they're making 5%, it's basically break even. So I don't like to see 5%, but and they're also diluting shareholders. So basically, Cava just needs to juice up that free cash flow. Once they juice up that free cash flow, they'll be able to stop diluting shareholders. But other than that, revenue is eye-popping. But we have Palantir, very low free cash flow yield like most tech stocks. Revenue is eye-popping, of course. Healthy balance sheet, return on capital is healthy, but they do dilute shareholders. And stocks like Palantir kind of get a pass because if you have a crazy run like Palantir, you kind of have to dilute shareholders just to cool off the stock and juice up your balance sheet, right? So I kind of give Palantir a pass for that. But the one thing I want to see from Palantir is juice up that free cash flow. Most likely they've been reinvesting all of that free cash flow into the business, which is why it's so low. But just juice it up a little bit and just slow down. As the stock comes down, slow down the dilution and rely on your free cash flow. But other than that, revenue and their return on capital is really good. Pepsi, so kind of low free cash flow yield. It has gone up a bit. It was trading at like 130 something, so I imagine it would have been a lot higher. But they pay out all of their free cash flow in dividends, so that is something that I would like to see changed. Juice up that free cash flow. Revenue trend, it's basically average, below average, 6%. They sell snacks. Like, what do you want from them? But no positive tangible book value. Return on invested capital is 10%, very good for a food company, and they buy back stock. So what I want to see from Pepsi is juice up their free cash flow to afford that dividend, because right now they're barely cutting it with the dividend, right? And once you get to a position where you're positive after buying or after paying dividends, then you can juice up the balance sheet, because the balance sheet is not looking good right now. So, but other than that, very good return on capital. REPX is a small cap oil stock. Very high free cash flow yield, but that's because the stock price has been beaten down because the market sees a lot of risk in a small cap oil company, right? Rightfully so. Dividend is affordable. Revenue trends kind of low, 5%, but very healthy tangible book value. It's almost trading at book value. Return on capital is good, but they're diluting shareholders. Recently, I will say though, they announced the stock buyback program, so they're at least trying, but I want them to slow down the dilution, because look, they make so much money in free cash flow. Like, their free cash flow yield is almost 17%, right? So there's no reason to be diluting all the time. But I know they've been making some acquisitions. But anyways, I just want to see dilution slow down. SoFi. So surprisingly, SoFi does not have free cash flow. I was kind of surprised to see that. But revenue, very impressive. Positive balance sheet. Return on capital is kind of low, but their revenue is pretty high. 5-year share count trend up, of course. Like most fintechs, they've been diluting, but SoFi just needs to get positive free cash flow. Similar to Lemonade, just get to a point where you're positive free cash flow and you stop diluting, right? So stop diluting, get free cash flow positive. Honest, man, just such a disappointment, man. They're basically trading at book value right now. But they sell diapers and wipes. Come on, guys. But what I want to see from Honest is kind of become like an Elf Estee Lauder, right? Get to a strong position with the Elf beauty brand. So cosmetics, skincare is a lot higher margin. So get that on the track. Don't abandon the baby business like wipes and diapers because it's still very important. But kind of get honest beauty on the right track so it can supplement, the lower margin business. Their margins are pretty good for like, a diaper company, but I don't know. I want to see honest beauty take off is what I want to see. VFC, I imagine it was trading at a 5% free cash flow yield before this recent run up to 20, but they can afford their dividend. Revenue trend has been negative, and their balance sheet is negative. So what I want to see from VFC is get to a point where your balance sheet positive, right, and get revenue back on track. So revenue gets back on track, your free cash flow will get back on track, and then that balance sheet will get juiced up. So that's kind of the picture that I want to see with VFC. Nubank, similar situation to SoFi, no positive free cash flow yet, but revenue is very good, balance sheet's good, but negative return on capital, surprisingly. They're like in hyper growth mode right now, but similar, basically the same situation as SoFi. I want to see positive free cash flow. Sprouts, surprisingly all green. Their free cash flow yield right now is 6.85%, which is very good. It's very good. No dividends, so all that free cash flow is just going right back into the business. Revenue trend 8%, very good for a grocery stock. Balance sheet is healthy. 13% return on capital, which is, wow, that is crazy for a grocery company, and they're buying back stock. So, what more can you ask for? Now we got the cruise lines. Similar picture, as you guys can see, low free cash flow yield. RCL pays a dividend that they cannot afford sometimes. So I want to see like free cash flow get juiced up. But revenue trend is back on the right track after the lockdowns. Balance sheet is healthy. Return on capital is okay, but they're diluting. So, and most of this is because they had to make it out of the lockdowns, right? But basically, just juice up free cash flow. And then once you juice up free cash flow, RCL can afford that dividend. And then they'll eventually be able to slow down that dilution. Unum, it's another insurance company. Another one that I've been looking at is Chubb. It's the one that Warren Buffett owns. I just forgot to put it on this list, but I will include that. Actually, let's just do that right now. I think it's CB. Yeah, so we'll keep that on there for next time. But 5% free cash flow yield right now, very impressive. Dividend that they can afford, but revenue is kind of slow. Very positive free cash or tangible book value. So they're almost trading at book value right now with a 5% free cash flow yield. So that's not bad. And they're buying back stock. So definitely on my watch list for that reason. Chipotle, low free cash flow yield, but when it comes to revenue, it is still good. Positive balance sheet. Their return on capital is amazing. And they're buying back stock. So they just got to juice up free cash flow, honestly. All right. But now we are going to react to this Keith D guy. So I'm just going to go with the most recent video that's not members only.
I want to let you in on something that's going on right now that a lot of people are not aware of, but that might be one of the biggest opportunities in the next few years. Everybody's hyper-focused on AI, crypto, and whatever's going on in the markets. But there's a massive opportunity that is sitting right under everyone's nose that will change everything for generations to come. Let's break it down. Over the next 20 years, more than $100 trillion is going to change hands. This is being called the Great Wealth Transfer. But what nobody's really talking about is how around 15 trillion of all of this is tied up in profitable, cash-flowing businesses that have no one to take them over. The kids don't want them, the spouses don't want them, and all they want is to just have cash, right? So right now, these baby boomers are the wealthiest generation in history. They are about to retire. And because of that, trillions will be inherited by millennials and Gen X. John Hope Bryant, who is the founder of Operation Hope, has been sounding the alarm about this.
There's $100 trillion of wealth transferring in the next 10 years. 15 trillion of that are businesses. Successful, profitable. Real estate having, brand having, they've been in business for 10 years, but what they don't have is a succession plan. The kids don't want the business, the wives don't want the business, the husbands don't want the business. They want the cash, the bonds, the stocks, the businesses. They want to go party because the first generation makes it, second generation spends it, third generation loses it. Am I going too fast? So out of the 100 trillion, there's 15 trillion. That's going to transfer in the next 5 to 10 years. These are successful businesses. Think about the biggest nursery in your little town. Think about the biggest dentist in your town. Think about the biggest daycare network in your little town. Go buy it. Yep. Don't do a startup for $25,000 on a GoFundMe campaign. It's going to go out of business in 3 weeks and your cousin's going to hate you because you got the money from them. Go buy a company with $1 million of existing cash flow and profitability with assets underneath it and get the bank to finance it on an asset-based financing with non-recourse debt.
The next generation wants tech jobs, remote work, corporate careers, startups. They don't want to be running a manufacturing plant or managing a plumbing company or owning a logistics firm. Let me paint the picture. There's a 68-year-old business owner who started a company in the 1980s, worked 60-hour weeks the entire time, employed people in his town, put his kids through college, and now he's tired and he would like to retire. But his kids are going to say, look, man, I don't want that business that you built up. Just sell it. And the reality is only about 30% of family businesses.
So one thing right off the bat I'll say about this is I agree with most of it. There's a lot of businesses that like older baby boomers have started, like immigrants, they'll come over here to start their own business, but now the kids don't want it, even though the business is successful. It's normal. The kids that inherit the wealth, whatever, they just want to go party, live life. I get that, right? And, for me, myself, for example, I like traveling. It's something I've always wanted to do my whole life, but I never have until recently. I recently went to Mexico, so I would like to do a lot of that. I didn't inherit any wealth. My parents weren't rich. My family's not rich. So I guess I'm first generation, whatever. I'm not rich yet, but I'm somewhat more freer, I guess you could say, than previous generations of mine. So I kind of feel that, even though I don't have a business, I just have assets. But I think one big thing that Robinhood has been talking about is having access to the private markets on Robinhood. And recently they announced the private venture fund ETF that they're rolling out, or they're about to IPO. So it's a trend that I'm seeing play out, but I think Robinhood needs to kind of pick it up. When it comes to like businesses like local daycares and whatnot, I guess it's not really gonna be marketable to like these private venture funds, if that makes any sense. Like, for example, if you buy an ETF on Robinhood, what do you want? You want like very exciting, shiny object type of companies, right? Like AI companies, or like, I don't know, some kind of biotech, it's going to change the world type of company. You don't want, like a daycare isn't super sexy. It might be super profitable, but it's not super sexy. So I don't know how Robinhood's going to do with all of that. I know they're trying to get into real estate, which isn't super sexy, but at least it's like real estate. So you could somewhat structure it like a REIT. So I guess Robinhood could do like a REIT fund and then just put a whole bunch of real estate in that basket and then let people buy it, collect the dividend, whatever. It'll be like a Robinhood REIT. But when it comes to stuff like this, it's a lot more for like the go-getters. People in your local town, If you're trying to buy like your local daycare, you're gonna have to do your due diligence. You're gonna have to know your town and whatnot. And when it comes to videos like this, it'll try to paint a picture that almost like it's easy to get rich, if that makes any sense. So it's a good opportunity, but it's like, what do you want me to do about it? You know what I mean? I like to focus on stuff like Robinhood, everything that they're doing, and he even says it in the video. Like people, the younger generation, we just want crypto, we just want stocks, we just want bonds, we want income right now, right? We just want easy to manage real estate. If we own real estate, we want someone else to manage it. That's kind of where we're at right now. So obviously it's an opportunity because nobody's looking for it. But it depends on if you're good at it, if you're willing to do the work, if you're willing to like hit the roads in your local town, see who's trying to sell their business or whatever. But yeah, it's like trying to start your own real estate company, buying a bunch of real estate. You're gonna have the capital. You're gonna have to know your local, city, your local market. You're gonna have to know a whole bunch of people, like realtors, your local network. It's a lot of work, and it's easy for like a YouTuber to kind of make it seem easy, or it just seems easy because it's a YouTube video, you know what I mean? So I don't know if that makes any sense. It's basically just me rambling, but I don't know, I'm reacting
to the second
to
generation,
the video.
and only 12% make it to the third. So what happens to all of the rest of these businesses? They close and completely go away, or they sell at a discount.
And this is nothing new. People have been doing this for a long time. Like, how many times in your local city have you seen like the local coffee shop change hands, and it's still a coffee shop, but it's just new owners? Like, people already do this. You know what I mean? Just another one that I could think of off the top of my head in my local town. Like a lot of Vietnamese restaurants, it'll change owners. It's still a Vietnamese restaurant, but just a new logo, right? Maybe slightly different taste because it's a new cook coming in. But this is nothing new, right? Or maybe like a real estate company, right? The old guard is trying to cash out, right? The boomer that has all the real estate in your local town, he wants to cash out and just live life on a yacht or whatever, and now it's a new real estate company coming in. So this isn't really anything new, but
this right here is the major opportunity. There are millions of businesses that have customers, that have employees, systems, revenue, and profits, but no owner for the next chapter of that business. And a lot of these businesses, right, don't need to have a sale happen at the highest valuation, right? They just want a responsible buyer. They want to know that their employees are protected, right? Because these people are.
And this is a lot of work. Like I said, if you're buying your local Vietnamese restaurant, right, or your local daycare, it's a lot of hard work. And usually it's a family-owned business, so they're able to keep costs low because the whole family is running it, right? So just keep stuff in mind.
Oftentimes friends and family, and they want their legacy to be continued. So they're willing to do things like what are called seller financing deals. They're willing to stay around if they need to kind of help with the transition. And they're also going to accept reasonable multiples for the amount of cash flow that the business is generating. But how does this stuff actually work? When people hear about the idea of buying a company, they assume that you need to be rich already, or just have millions of dollars sitting around in cash, or that you need to raise millions of dollars from someone else. But in the world of small business acquisitions, you don't necessarily need any of that. Most deals that are happening in the small business acquisition world are happening through two major tools. One of them is seller financing, and the second are SBA loans, or Small Business Administration loans. Let's break these things down real quick.
All right, so if you're going to be doing some of this, like taking out debt to buy out your local company, your local business, first of all, you have to make sure it's something that you actually want to do, right? Like, if you don't enjoy running a daycare, taking leverage, taking debt to buy your local daycare, and then you running it yourself is going to be a massive headache, because now you're a slave to the bank and you're a slave to this business that you're trying to keep afloat, right? So just keep that in mind. make sure it's a business you actually want to run.
Real quick. Seller financing is when the owner of the business acts like the bank, and they let you pay for the business over time. So instead of you paying 100% upfront for the business, where you take either your own cash or get a traditional loan to make the purchase, the seller says, look, pay me part right now, and then the rest over the next few years. Now, why would a seller want to do this? Seller finance is $900,000. A bank lends you the money, and the government guarantees a large portion of the loan. Is when a bank finances the business purchase, and the government.
Okay, I mean, he's probably getting into the nitty gritty here, and I know there's like also a lot of government programs that help small businesses, stuff like that, that you guys could probably take advantage of if you want to start a small business, whatever. But keep in mind, if you're gonna, it's like opening a new restaurant, right? Don't just open a new restaurant thinking you're gonna milk money while sitting on a beach somewhere. Like, you're probably gonna have to do a lot of hands-on work. You're probably gonna have to be one of the employees starting out, and it's probably gonna be a lot of work. And if you have debt, now you're really committed to it, and you feel like it's taking over your life. So just keep that in mind.
Whoa. Wait a minute. Before you lose your mind, stick with me here. This one is likely to make a lot of people upset. And while that is not my intention, I do want to make it clear that the goal here is to keep this as objective as possible. And so if you do find yourself triggered at any moment throughout this video, please just let me know in the comments down below exactly why that is. And if you think you know how this story ends, stick with me, because by the end of this, you might actually completely change your perspective on what is actually occurring in the world of digital assets. First, let's break something down that can otherwise be a little bit confusing. Because when it comes to these digital assets, we typically have two different components that are sometimes referenced as one thing. So we have, for instance, the network, and then we have the token. So for Bitcoin specifically, you have the Bitcoin network and the Bitcoin protocol, which is essentially just software that is being run by different computers all over the world. You can think of the network as like a public utility, or imagine like a public transportation or the subway specifically, right? And then you have the token. So you can think of Bitcoin, the token, as this native asset that you can use on that network. Now, this token, you can imagine, can have demand and value based upon the utility of the network. The more that the network can do, or the more value that this network provides, then the more value that the token that you can use on that network may have. Think of the token like a key card or your ticket to be able to get into and then use a public transportation like the subway. Now let's talk about why Bitcoin specifically exists. Bitcoin came out of the financial crisis in 2008. Some say that that's a coincidence. We're not here to talk about that. The reality is that Bitcoin was designed to solve a couple of different problems. One of them being the double spend problem. The idea here is that before Bitcoin existed, essentially anything on the internet could be copied endlessly. That goes from music to movies to even money. Digital dollars that we have today and that we've had for quite some time work only because of a central authority that essentially prevents there from being the same double spend or copying effect. These central authorities, like your bank or even PayPal, only work because they have their own databases that they're cross-referencing information on to make sure that you can't spend the same dollar twice. But you have to have full trust in these institutions like the bank or PayPal to make sure that they do right by you, because they can freeze or reverse transactions whenever they feel like it. Bitcoin changed that, especially for money, because on the Bitcoin network, first off, there's no central authority at all. In fact, the only authority is the code itself that everyone that's using the network is actually agreeing upon the rules of. Bitcoin created a network where you could have data, information, and even money that cannot just be duplicated or printed at will. There will only be 21 million Bitcoin, and that is hard-coded into the code. Now, that could change if a certain percentage of everyone on that network agreed upon it, but that is the only way. So no government, no founder or CEO can just change the code without everyone else agreeing. Now, part of the way that this whole system works is through what's called a consensus mechanism. And in particular for Bitcoin, this consensus mechanism is called proof of work. And a consensus mechanism is just a way for all of these different computers to
Okay, he's doing like an introduction. I'm just trying to...
Can't do anything with. They also are going to incur what are called foreign exchange or FX risks as well. During this transaction, Bank A will actually go to the foreign exchange market and buy back the yen that it had to use to settle that transaction in Japan. The thing about all of this is that the foreign currency values can shift up and down. It takes time for all of these payments to settle. So the banks are taking the risk that the value of the yen could go up or down drastically while this is all taking place. XRP is designed to upgrade the system by acting as a bridge asset. Here's what that means. Imagine Bank A takes its US dollars and buys XRP. When it buys that XRP, it then sends it over to Bank B, which will settle within 3 to 5 seconds. Bank B will then take that XRP, sell it into yen, and now the complete transaction is done within seconds when it may have taken days using the traditional correspondent banking system. This could free up trillions of dollars, because now instead of having to hold foreign currency reserves, banks could actually just hold the XRP and transfer it and sell it into the asset that they need as they need it. This also helps to solve that foreign currency exchange risk, because now you hold XRP, which can settle within seconds in and out of whatever currency you need. Bitcoin's network processes transactions every 10 minutes or so, and it takes several blocks for transactions to be considered secure. So because of this, one single Bitcoin transaction can sometimes take more than an hour to actually be confirmed and considered secure. During periods of high demand, Bitcoin's transaction speed can slow down drastically due to the congestion of the network and that high demand for block space. This can also make Bitcoin transactions more expensive in periods of high demand, because that block space essentially gets auctioned off at a higher price.
All right, like, I mean, I know you guys wanted me to react to the whole video, but this is where I'm at, like, with crypto and in general. Like, I'm not going to pretend like I'm some crypto guru, okay? I don't freaking understand this crap. But I'm willing to invest in it and trade it, okay? That's where I'm at. It's kind of like my approach with stocks. You know, I don't have to be that employee, that veteran employee that's been with Nike 2 decades, longer than I've been alive probably, that knows the business inside and out, when I could just own a slice of Nike, right? Like the CEO, for example, he started as an intern. You know, he's worked his way up. He's probably worked there longer than I've been alive. He knows that business much more than I do. He's much more experienced in life and in business than I am. I'll just let him handle that. You know what I'm saying? That's kind of where I'm at with crypto. I don't know which crypto is going to be number one top dog. Like, the reason why I don't trust Bitcoin that much is because I'm not really familiar with the origins of it. I don't know who this Satoshi dude is. And it's kind of, people say it's digital gold, but it's like, what is it really? You know what I mean? It's just, the value of it is whatever people's willing to pay for it. And yes, you could say the same thing about gold, but at least gold, I can hold it in my hands, right? That's kind of where I'm at with Bitcoin. Y'all can call me a boomer if you want. I don't think I own any Bitcoin. Maybe I have like a super old wallet that I used to play with during like the lockdowns that might have like a couple dollars of Bitcoin. But other than that, I don't own any Bitcoin. I own some ETH because it's utility, right? Same with Solana, there's a utility to it. XRP, I have like one XRP because Robinhood gifted it to me, and I don't know, there's no point in selling it for $2. But you know, I'm willing to hold them, and it's less than 1% of my net worth. That's where I'm at with crypto, right? This is basically what I'm going to say. There's always going to be some new crypto coin or some new hot, fresh, sexy company startup that sells you that this is like the new thing. This is going to be the way people do things. And you guys, you have to kind of be cautious around that. I know that's how Robinhood started, where they came out and they said, all right, from here on out, there's no commissions. Stock trading is going to be free, right? Obviously, Robinhood takes a little cut here and there, like a few pennies, but it's basically free now. I mean, it's better than paying $50 per trade, right? You know, I'm willing to accept the few pennies that Robinhood takes. But that's like their mission. And, you know, it's worked out. But not every single company is going to work out, right? For example, Webull. Correct me if I'm wrong, but Webull's crashed, right? Most cryptos have not recovered since the lockdown boom when crypto was everything. So I'm basically just saying be careful. I keep crypto like less than 1% of my net worth. I know right now, I think crypto has max fear. Like, nobody wants crypto right now, and software stocks. Bitcoin's been beaten down, and Bitcoin is kind of like the sentiment meter for the rest of the crypto market, right? Ethereum has been beaten down. Solana has been beaten down. I think Solana was like, 200 plus, and now it's 80. So it's crazy. XRP's been beaten down a little bit. So I think right now might be a good time for me to increase my allocation net worth wise to crypto. But at the same time, you could argue that more than half of my net worth is crypto because of Robinhood, right? They have a crypto business. So you could say that a lot of my net worth is allocated to crypto. And they got Robinhood Chain, right? Like that's what I'm saying. I don't understand any of this. I don't know what the Robinhood chain is. I know that it's like on Ethereum or something, and people can tokenize assets on the Robinhood chain, whatever. I'm not a crypto expert, but I have Robinhood stock. They do all the hard work for me. You know, I'll dabble in some crypto here and there, a little bit of ETH, a little bit of XRP, a little bit of Solana here and there. I'll collect my staking rewards, and I'm gonna just chill, right? Basically what he was saying in the previous video, like this generation, most likely my generation, we just want to chill, buy crypto, chill, right? I want my dividends, I want my rental income, I want my staking rewards. I'm just trying to cash out and sit on a beach somewhere, right? That's basically where I'm at. Sorry if this reaction isn't like what you guys wanted, but like, I don't know what you guys want me to say, right? Or I do know. Most of you guys probably want me to be like, this is the stock, or this is the crypto that you should be buying. Like, you should be buying XRP, but like, I would be lying, right? I'm not a shill. You know, even with Robinhood stock, a lot of people were getting mad at me because I wasn't like selling, super excited about Robinhood stock when it was going all the way up to 130, 150, and I was like, whoa, slow down. You know, you guys should be managing this a little bit, managing your risk. You know, like personally, I was selling covered calls, and I got a little bit of heat from that, right? A lot of people were like, well, if you're bearish on Robinhood, why don't you just cash out? And so I guess that's just how I am. I don't get too excited about things, but I just like, what piques my interest is when things are beaten down so much and nobody's interested in it. So for example, right now, software stocks, you know, the software sector, crypto sector, fintech, beaten down hard right now. And that piques my interest. But right now, you know, what's popping? Like semi stocks, hardware stocks, memory stocks. Like, you know, I did miss out. I wish I bought SanDisk and got that 1,000% return, but I missed out. It is what it is, right? It's good to be educated on these things, right? Obviously, if you know a lot about memory and chips, then maybe you did catch that 1,000% return in SanDisk. And if you know a lot about XRP, maybe you bought it when it was like a couple cents or something and you rode that wave. But yeah, I don't know. You're not going to catch them all, right? And I know it's not the most exciting message, and I'm not the most exciting person, but that's what I think. So, but that's basically an hour right there. I thought it was going to be longer than an hour just because of the videos that I had to react to, but I guess I'm just going to cut it short for you guys because, you know, if I would have kept it running, I would just be milking you guys, milking watch time, and that's just not how I am. You know, I just like to get right to it. And if you guys want to, you can check out this video, get to the technical nitty-gritties of it. I'll probably watch the rest of it just to, you know, kind of see what you guys are thinking. I'll learn a little bit, maybe more about what XRP is. But yeah, I guess that's just the message that I'm going to leave off in this video. But that was an hour for you guys. By the way, my website does not look too good. Well, it doesn't look good mobile or PC, but it definitely doesn't look good in PC. But if you guys did want to support me, have your comments highlighted. I don't have YouTube monetization yet, so you can't do the super chat. But what you can do is do a buy me a coffee, and I have my crypto wallets here as well, but you don't have to do that. You can just go through buy me a coffee. It'll give you like a little prompt where you guys can comment alongside your $3. So, you know, I'll have your comments highlighted on my video and I'll respond to it. And another thing that I'm trying to work on is like a meter. So like a goal meter of how much Ethereum you guys donated to me, how much buy me a coffee you guys donate to me. So I'm trying to up my production value for you guys. I know it's a little bit bootstrapped right now, right? But I appreciate you guys that stuck through the whole video. If any of you guys watched the whole hour, let me know, because that is commendable. But I'll catch you guys next time. Peace.